Welcome back to the Trading Desk. Dave, Paul Kudrowski, it was a gracious guest. He actually sat down with me for an hour, and that was after I met him here at the VC conference in the fall. So great interview, and I encourage you to go online and see the whole thing if you want. It's on my blog. Anyways, let's get to the topic. I mean, he was talking a lot about how, again, what we talked about earlier in the show, that sometimes the creative destruction that happens through bubbles and bursts is a positive thing. And he talked a lot about IPOs. You know, he said, hey, Facebook, I see going public, possibly Twitter this year, against some of these social entities. And that momentum.
And it's good. We've gone from banking or finance related, wealth creation, now to technology. But I think what was the most interesting, at least for me in that interview, was that talking about how some of the really bright minds from Wall Street, they may decide to go back into the scientific community, which is where a lot of them originally were tracked to initially, but they got lured by the cash.
Yes.
I mean, those people could go into green technologies or any other type of field that might have a little bit more of an impact on our economy than just simply creating financial.
Yeah, Paul talked about it a lot. I mean, there was so much money. This is what, and we've never seen this in our lifetimes, where you had computer scientists, PhDs, and economists, guys that typically aren't in the trading world, were doing all types of modeling for desks because so much of it is quant driven. They were creating these high frequency trading techniques and models.
Which was all fine and good, but is that maybe, and again, this is more of a social commentary, is that really the best use of their brains? Maybe we're better off having them in some other sector.
But again, this is where the money, the capitalism was thrown at them, and you can't blame a guy. Hey, you want to pay me $500,000 a year to write some code?
And now you might start to see somebody throwing them $500,000 to go and work on some new tech startup, which would be far more beneficial, or potentially more beneficial.
Right, and one of the other things that he sees from that fallout is, the VC firms also, and you're seeing this happen in transition. The VCs and the private equities are getting their haircuts. They had too much capital that they're not able to employ in the right manner.
Exactly.
Maybe they should be looking at $3 to $5 million deals
instead of several billion.
Instead of $100 million and up, exactly. And I think that's what happened. You had so much money over so many areas that it just wasn't being utilized properly, in which has driven a stagnation. Yeah, but it's also driven a stagnation in the little business, and that still that transition I think is important. Wrapping it up with the banks have to start lending, and until they fail, they can't get into the lending business because they have all these bad debts.
Right, to finance those small operations that have the creative ideas.
Right.
That's a great point. Why don't we talk about some ways that we can make our viewers some money with our fantasy finance picks. We'll go to Matt's chart first, and again, banking.
See, we're talking about banks. It does happen to work out this way, but the chart to me, again, you go back to August. It's just been languishing here across a range.
This is an ETF of regional banks. Is that correct?
This is a regional bank holder. So again,
RKH, I think.
This is RKH. So you're betting that if you buy this, you're betting that regional banks are going to succeed. I'm actually saying that this has had good success, 30 to 85. I'm actually saying to short this, so sell this short. You can do this again with an ETF. It's just a short sale of the banks here. I think we've had a good 10-month run up here, and this is going to pull back some. It's trading around $79, $80, been as high as 85. Your backstop again, Dave, is only about 4.5%, 5% at 85. It goes over that, you're out of the trade. But otherwise, stay in it. I think banks have some pain to go through on the regional side.
I totally agree. I think that obviously a lot of this was due to interest rate and quantitative easing. Now the reality is setting in. They actually have to go back to the banking business of lending and making money, and
they're not.
That's going to be a tough gig. So I'm with you on that one. I think that's a good reward relative to the risk you're taking.
Right. How about you, Dave? What do you have for us this week?
I'm kind of going back to an old, one we've been talking about for quite some time. Declining gold prices, which means the dollar's rallying. I like this rally we've had in the last couple of weeks. We've come up to this resistance area, this trend line resistance. So I'm bearish on gold prices. This ETF, which is DGZ, if you buy this, you're actually betting on the price of gold going down. So gold goes down, this ETF rises in value.
So we're both taking short bets. Your ETF, you're actually buying, and as gold goes down, this goes up. My ETF, RKH, you have to actually sell to make the benefits.
And they're actually both deflationary-oriented trades.
Right.
We've been inflation-oriented. It hasn't really played out the way I thought it would.
Right.
But I think both of our bets are spot on.
Great.
I want to thank you again for joining us. It was another great show. We'll be back in a couple of weeks with another episode. Thanks for watching The Trading Desk on COTV, Channel 11.